In the American markets, where trillion-dollar companies usually dictate the pace of innovation, there are still moments when a mid-cap operator does something so violently out of pattern that it forces every rational investor to stop and ask how this is even possible. The story of IREN is exactly that kind of rupture. Not a surprise, not a lucky break, but an outright statistical anomaly. A company that began in 2018 as a renewable-powered Bitcoin miner somehow emerged by late 2025 as the counterintuitive anchor of nearly $10 billion artificial intelligence cloud agreement with Microsoft. And it accomplished this during the tightest GPU shortage in modern computing history. For investors who understand how infrastructure procurement usually works, this was not only unexpected, but deeply disorienting. To appreciate the scale of the anomaly, we need to understand what normal looks like. A Bitcoin miner with modest power contracts usually expands slowly, megawatt by megawatt, transformer by transformer, hosting client by hosting client. Diversification into high-density artificial intelligence compute, especially liquid-cooled GPU clusters, normally requires many years of certifications, hyperscale-grade electrical engineering, redundant fiber routes, and an extensive operational track record. Hyperscalers like Microsoft, Amazon, and Google almost never outsource large AI workloads to companies that lack these credentials. They rely on operators with decades of data center experience, not firms still navigating litigation over earlier disclosures. IREN did not follow any of these norms. In November 2024, it rebranded from Iris Energy to IREN. A rename is not unusual, but using it as an entry point to a transformation of extraordinary magnitude is rare. At the same time that a class action lawsuit filed in 2024 claimed that IREN overstated the progress of its Childress, Texas site for investors buying between mid-2023 and mid-2024, the company accelerated construction at that same location. And while doing so, it quietly began high-end NVIDIA GPUs at a pace that defied even the most optimistic procurement models. By mid-2025, IREN held more than 23,000 GPUs, including Blackwell generation accelerators. Under normal industry practice, GPU allocation flows first to hyperscalers, then to large enterprise integrators, and only then to smaller operators who receive later and often partial shipments. IREN obtained hardware faster than operators with market caps in the hundreds of billions. This raises the first major question. How did a former Bitcoin miner bypass a deeply entrenched GPU allocation hierarchy? Investors have proposed multiple theories. Maybe IREN locked in volume contracts far earlier than expected. Maybe its unusually large and immediately available power capacity gave NVIDIA and Dell strong incentive to prioritize it. Or, in